Hey everyone, and welcome back for another deep dive with us. So today we're looking at something that I know a lot of you have been asking about. Is VGT still a good investment for 2025? That's the Vanguard Information Technology ETF, in case you're not familiar.
Yeah, and it's a big one. I mean, it's been one of the hottest ETFs for a while now.
Yeah.
And a lot of people are wondering if it can keep up that momentum.
Exactly. And that's what we're going to try to figure out today. So we've got some great research lined up, an article that really digs into the potential of VGT. And we're going to see if it can really outperform the S&P 500.
Right, because that's the big question, right? Everyone wants to know if they should stick with tech or go for a broader market approach.
Exactly. Now, we know that VGT has had some pretty impressive returns in recent years. I mean, in 2023 alone, it was up 56%. The S&P 500, on the other hand, gained 26%. So it's more than doubled the returns of the broader market.
Yeah, that's pretty impressive.
And over the past decade, VGT has just been crushing it. I mean, something like 580% returns compared to the S&P's 280%.
Wow. That's quite a difference.
It is. But, past performance doesn't guarantee future results. So we got to look deeper. So let's break down what VGT actually holds. What are the companies that are driving these returns?
Well, the first thing to understand is that VGT is very heavily concentrated in a handful of tech giants. We're talking about the biggest names in the industry: Apple, Microsoft, NVIDIA, Broadcom, Adobe, Salesforce. Those are some of the heavy hitters.
It's like a tech all-star team.
Exactly. And as of early 2024, just Apple and Microsoft alone made up about 42% of the entire ETF.
Wow, that's a lot of weight on just two companies. So I guess the big question is, what happens if one of those companies stumbles? Does that drag down the whole ETF?
Well, that's the trade-off, right?
Yeah.
On the one hand, these companies have been responsible for a huge chunk of VGT's success. They're the innovators. They're pushing the boundaries in areas like AI, cloud computing, semiconductors. But yeah, that heavy reliance on a few players definitely makes VGT more vulnerable. If one of those giants has a bad quarter, it's going to have a bigger impact.
That makes sense. So let's unpack those potential growth drivers a little bit. Everyone's talking about AI these days, and it seems like VGT is really well positioned to benefit from that. But how exactly are these companies making money from AI? Is it all hype, or is there real substance behind it?
Well, there's definitely real substance. It's not just a buzzword. AI is already transforming industries. And these companies are at the forefront. Take NVIDIA, for example. Their chips are the brains behind everything from self-driving cars to those AI image generators that everyone's using. And that kind of widespread adoption is why they're such a major player in VGT.
Yeah, I see those AI images popping up everywhere online.
Exactly. And that's just the beginning. As AI applications continue to expand, NVIDIA and other companies like them are going to see huge growth.
So it's not just some abstract concept, it's real-world stuff that people are using every day.
Exactly.
But is that enough to justify the high valuations we're seeing in the tech sector? I mean, some people are saying these stocks are overpriced.
Yeah, there's definitely that concern, especially when you look at their forward PE ratios, which basically tell you how much you're paying for each dollar of a company's expected future earnings. And some of those forward PEs are pretty high.
So investors are really banking on strong growth.
Yeah, they're betting that these companies will continue to deliver impressive earnings. And if growth slows down, those high valuations could be a problem.
Okay, so AI is a big potential driver. But what about other trends that could impact VGT? I know there's been talk about a semiconductor revolution, the expansion of cloud computing, even potential interest rate cuts in 2025. How do those factor into the equation?
Well, let's start with semiconductors. They're essential components in pretty much every new technology we're seeing. AI, electric vehicles, cloud computing, smartphones, you name it. And that's why companies like NVIDIA, AMD, and Broadcom, all part of VGT, are in such a strong position.
So they're kind of like the picks and shovels of the digital gold rush.
Exactly. They provide the building blocks for all these exciting new technologies.
And what about cloud computing? It seems like every business is moving to the cloud these days.
It's true. Cloud-based services and enterprise software solutions are becoming more and more important for businesses of all sizes. And that's creating massive opportunities for companies like Microsoft with Azure Amazon, with AWS Google with their Google Cloud platform. Even companies like Salesforce and Adobe, which focus on specific enterprise software needs, are seeing huge growth.
And all of those companies are major components of VGT, right?
Exactly. So their success is directly tied to the success of the ETF.
So lots of potential tailwinds for VGT. But we got to talk about the other side of the coin, too, the
Yeah.
potential risks. What are some of the things that could derail VGT's performance?
Well, one concern is that some tech stocks might be overvalued, like we were talking about earlier with those high forward PE ratios. If there's a market correction or an economic slowdown, VGT could get hit harder than a more diversified index like the S&P 500.
Yeah, that makes sense. If the market takes a dip, VGT's concentrated focus could work against it.
Right, it's all about managing expectations and understanding the risks.
So even with all this excitement around AI and other technological advancements, there are some legitimate concerns that investors need to weigh carefully.
Absolutely. It's not all sunshine and rainbows.
So let's break down those risks a little bit further. What are the specific concerns around AI adoption, and what would a resurgence in other market sectors look like?
Well, when it comes to AI, some experts are cautioning against overly optimistic projections. They point to the challenges of monetizing AI applications, the substantial costs of building and maintaining the necessary infrastructure, and the fiercely competitive landscape.
So it's not just a matter of build it and they will come. There are real hurdles to overcome.
Precisely. Companies need to figure out sustainable business models for their AI products and services. They need to ensure they can generate revenue that justifies the significant investments they're making.
And what about the competition? It seems like every tech giant is racing to stake their claim in the AI gold rush.
Oh, absolutely. The competition is fierce, and it's not just limited to the usual suspects. Startups are emerging, challenging established players with innovative approaches and agile strategies. This dynamic landscape adds another layer of complexity to the equation.
Okay, so we've explored the AI landscape and some potential pitfalls, but what about the possibility of other market sectors gaining momentum? How could that impact VGT's performance compared to the S&P 500?
Right, that's another key consideration. Remember, the S&P 500 represents a broad cross-section of the U.S. economy, encompassing sectors like energy, healthcare, financials, industrials, consumer staples, and more. If investors start rotating out of tech and into these other sectors, it could create headwinds for VGT.
So if, say, oil prices surge or there's a breakthrough in renewable energy technology, the energy sector could outperform, potentially pulling the S&P 500 ahead.
Exactly. Or if interest rates rise significantly, it could benefit financial institutions, giving them an edge. Healthcare is another sector with long-term growth potential, driven by an aging population and advancements in medical technology.
Yep.
The point is, the market is constantly in flux, and sector performance can shift dramatically based on a wide range of factors.
Yeah, it's like a game of musical chairs. When the music stops, investors want to be sitting in the sector with the strongest growth potential.
Exactly.
And that's where the diversification of the S&P 500 comes into play, right?
Right. By investing in a broad market index like the S&P 500, you're spreading your risk across multiple sectors. This can help cushion your portfolio against volatility and potentially provide more stable returns over time.
But wouldn't that also limit your upside potential? If tech continues to surge, wouldn't you miss out on those gains by being spread too thin?
That's the trade-off. Diversification can mitigate risk, but it might also limit your potential for outsized returns. It's a classic dilemma for investors balancing risk and reward.
Okay, so far we've laid out the bull case and the bear case, the potential rewards and the potential risks of investing in VGT versus the S&P 500. But ultimately, the question remains, which one makes more sense for 2025? Where do we even begin to unpack that?
Well, I think it helps to start by just recapping the core arguments for each right. So for VGT, it really boils down to the potential for continued strong earnings growth, driven by those megatrends we've been talking about: AI, cloud computing, semiconductors. And then there's also the possibility of interest rate cuts, which could give tech valuations another boost. And of course, you can't ignore that historical outperformance. VGT's been a winner for a long time.
And what about the argument for the S&P 500?
Well, the S&P 500 is all about diversification. You know, it's potentially less volatile compared to a sector-specific ETF like VGT. And then there's the possibility of a broader economic recovery, one that could benefit those non-tech industries more.
So it's kind of like choosing between a high-growth, potentially bumpy ride with VGT or a smoother, more diversified journey with the S&P 500. I mean, how do you actually decide which path is right for you?
That's where it gets really personal. You know, it comes down to your individual investment goals, your risk tolerance, your time horizon.
Right, because a 25-year-old investor who's saving for retirement decades down the road, they're probably going to have a very different outlook than someone who's closer to retirement and needs to protect their nest egg.
Exactly. And even within those broad categories, there's a whole spectrum of risk appetite. Some people are perfectly comfortable with more volatility, while others really prioritize stability and peace of mind.
And let's not forget about the emotional side of investing too, right? It's easy to get caught up in the hype, especially when you see those eye-popping returns.
Oh, absolutely. Fear and greed can really cloud our judgment. That's why it's so important to have a plan and stick to it, even when the market gets turbulent.
So let's say you've thought about your goals, your risk tolerance, and you're still kind of on the fence between VGT and the S&P 500. What are some questions that you should be asking yourself to make that final decision?
Well, one question to consider is how comfortable you are with the concentrated nature of VGT. Are you okay with a large portion of your investment being tied to just a handful of companies? Or would you prefer a more diversified approach?
Yeah, that's a great point. It's like deciding whether to bet on a single horse or spread your bets across the entire field.
Exactly. Another question to ask is how much research you're willing to do. If you're investing in VGT, you should really understand the businesses of those top holdings, their competitive landscape, their growth potential. With the S&P 500, you're essentially betting on the overall U.S. economy, which requires a broader understanding of macroeconomic trends.
So VGT might be a good fit for someone who enjoys digging into individual companies, while the S&P 500 could be more appealing for someone who prefers a more hands-off approach.
Exactly. And finally, you need to consider your investment timeline. If you're investing for the long term, you can ride out the market's ups and downs. But if you need access to your money in the short term, you might be more sensitive to market fluctuations.
So it's not just about picking the investment with the highest potential return. It's about finding the one that aligns with your individual circumstances and helps you sleep at night.
Precisely. Investing shouldn't be a source of stress. It should be a tool that helps you achieve your financial goals.
Well said. Now, as we're wrapping up our deep dive into VGT and the S&P 500, I think it's important to acknowledge that these aren't the only options out there. There's a whole universe of investments, from individual stocks to bonds to real estate.
That's right. And depending on your goals and risk tolerance, there might be other investment strategies that make more sense for you. For example, some investors prefer to focus on specific sectors or themes, while others opt for actively managed funds. There are even those who embrace alternative investments, like cryptocurrencies or collectibles.
So many choices. It's enough to make your head spin. But that's why it's so important to educate yourself and explore different options. What works for one person might not work for another.
Absolutely. And that's what we're trying to do here, provide you with the knowledge and insights to make informed decisions that are right for you. We're not giving financial advice. We're empowering you to take control of your financial future.
Now, speaking of different investment approaches, I think this is a good segue into a related topic that often comes up. Active versus passive investing. It's a bit of a philosophical debate in the investment world with strong opinions on both sides.
Yeah, the age-old question. Do you try to beat the market or simply ride the wave?
Okay, so for those who might be new to this, can you give us a quick rundown of what active and passive investing actually mean?
Sure. Active investing is about trying to outperform the market by picking individual stocks or actively managed funds. It's a hands-on approach that requires research analysis and often a willingness to take on more risk.
So it's like being a stock market detective trying to uncover hidden gems and make those savvy moves that will give you an edge.
Exactly. And the allure of active investing is that in theory, it offers the potential for higher returns. If you can consistently pick winners, you can theoretically amass significant wealth.
But there's a catch, right? It sounds like it requires a lot of expertise and a bit of luck.
Well, there are actually several catches. First, it's incredibly difficult to consistently outperform the market over the long term. Numerous studies have shown that the vast majority of active fund managers fail to beat their benchmarks after fees are taken into account.
So it's like trying to time the waves at the beach. You might catch a few good ones, but the ocean always has a way of humbling you.
Precisely. Second, active investing typically involves higher fees than passive investing. You're paying for the expertise of the fund manager, and those costs can eat into your returns.
And those fees add up over time, compounding the challenge of outperforming the market.
Exactly. Third, active investing often involves more trading, which can trigger capital gains taxes.
Yeah.
This can further erode your returns, especially if you're investing in a taxable account.
So while the potential for high returns might be tempting, there are some serious hurdles to overcome with active investing.
Now let's turn to passive investing. The main advantage here is simplicity and lower costs. Index funds typically have very low expense ratios because they're not actively managed. You're essentially buying the entire market in one go, riding the overall trend.
So it's more like hopping on a train and enjoying the scenery. rather than trying to steer the locomotive yourself.
Exactly. And historically, the market has trended upward over the long term. So by investing in a broad market index fund, you're capturing that overall growth without the hassle and expense of active management.
And because you're not constantly buying and selling stocks, you're minimizing trading costs and potential tax liabilities.
Precisely. Passive investing can be a very tax-efficient way to build wealth over time.
So passive investing seems like a more straightforward, less stressful approach for many people.
For many investors, it is. It's a way to participate in the market without having to spend countless hours researching stocks or worrying about market timing.
But doesn't that also mean you're settling for average returns? You're not trying to beat the market, just match it.
That's true. With passive investing, you're accepting the market's overall performance, whatever that may be. You're not trying to swing for the fences, just get on base consistently.
So it's a trade-off. Active investing offers the potential for higher returns, but with higher risk and higher costs. Passive investing provides a simpler, lower-cost way to capture market growth, but without the possibility of outsized gains.
And ultimately, the best approach for you depends on your individual circumstances, your investment goals, your risk tolerance, and your level of involvement.
It's like choosing between a five-star restaurant with a prefix menu and a casual buffet. Both can be great options. It just depends on your taste and your budget.
That's a great analogy. And remember, there's no right or wrong answer. It's about making informed choices that you're comfortable with.
So we've been talking about active versus passive investing. And honestly, it's a topic that could have its own deep dive.
Oh, yeah, definitely. There are so many nuances and different approaches within each strategy.
Exactly. But for now, let's try to at least give our listeners a little taste of the key considerations. Would you say that the main difference boils down to control versus convenience?
I think that's a pretty good way to put it. With active investing, you're really taking the reins. You're making specific choices about which companies or funds to invest in. You're basically saying, I believe I can do better than the market average.
So it's kind of like choosing your own adventure in the stock market.
Exactly. And that can be really exciting for some people. They enjoy the research, the analysis, the thrill of trying to outsmart the crowd. But it also comes with responsibilities. You need to stay informed, monitor your investments, be prepared to make adjustments as needed.
So it's not a set it and forget it approach. You're actively managing your portfolio, which takes time, effort, and a certain level of expertise.
Absolutely. You need to understand how to evaluate companies, assess risk, and make informed decisions. And even then, there's no guarantee of success. The market can be unpredictable, and even the most skilled investors make mistakes.
So active investing is not for the faint of heart. But what about passive investing? Is that more of a hands-off approach?
Yeah, passive investing is all about accepting market returns rather than trying to beat them. You're essentially saying, I'm happy to go along for the ride as long as the ride generally goes in the right direction.
And that's where those index funds come in, right? They're like the cruise ships of the investment world. You just hop on board and let the captain navigate the market for you.
Exactly. Index funds track a specific market index, like the S&P 500, by holding a basket of stocks that mirror that index. So you're essentially buying a slice of the entire market in one go.
And since you're not trying to pick individual winners and losers, there's less need for that constant monitoring and analysis.
Right. Passive investing can be a very low-maintenance approach. You choose your index funds, set up your contributions, and then let the market do its thing.
But isn't that a bit boring for some people? Doesn't it lack that element of excitement that comes with active investing?
It can be. But for a lot of people, the peace of mind and the lower costs outweigh the thrill of trying to beat the market. They're happy to let the professionals manage the details and focus on their long-term goals.
So it really comes down to personality, risk tolerance, and how much time and effort you're willing to put into managing your investments.
Exactly. There's no right or wrong answer. It's about finding the approach that aligns with your individual circumstances and preferences.
And as you mentioned earlier, some investors choose kind of a hybrid approach, combining active and passive strategies.
That's right. They might have a core portfolio of index funds to capture that broad market growth, and then allocate a smaller portion of their assets to individual stocks or actively managed funds in areas where they have particular interest or expertise.
So it's like creating your own investment recipe, adding a dash of active management to spice things up.
Exactly. It's all about finding the right balance for you.
Well, I think this has been a really helpful exploration of active versus passive investing. We've covered a lot of ground today, from the specifics of VGT and the S&P 500 to the broader philosophies of how to approach the market.
Absolutely. We've touched on some complex topics, but hopefully we've demystified some of the jargon and given our listener a better understanding of the key considerations.
And ultimately, I think the most important takeaway is that investing is a personal journey. There's no one-size-fits-all solution.
That's so true. The best advice we can give is to educate yourself, explore different options, and make informed decisions that are right for you.
And don't be afraid to ask questions. Seek guidance from trusted sources. And, adjust your strategy as your needs and goals evolve over time.
Couldn't agree more. Investing is not a sprint, it's a marathon. It's about building a solid foundation for your financial future, one step at a time.
Well said. Well, we hope this deep dive has been valuable for everyone, and we look forward to diving into another fascinating topic with you all again soon.
Until next time, happy investing.